What's good everyone, welcome back to my second video of my course on my YouTube channel, and this video we're going to cover understanding order flow, liquidity and imbalances. So I'm going to be assuming that most of you don't really understand what order flow is and liquidity in general, and I'm going to try and put this into pieces for you all in this video. So first we will go over order flow, then we'll cover liquidity and imbalances. And before we get into the second video, I do want to say that once I do upload this course on my YouTube channel, there will be people that will obviously resell what I've said, and they will try and say that it was something that they already knew about, or something that they found a secret in trading or some stuff like that, and they will try and sell it to their audience. So I want to just let you guys know that what I am giving you, I do believe the structure I'm giving you is probably one of the best free courses that is out there. And if I was in your position when I was starting off, I would have killed for something like this because I'm doing it completely free. I'm doing it out of my time. So I would appreciate you guys hitting the subscribe button if you haven't already. And if you do have any questions regarding the course in general or any topics that I have covered and you're struggling on it, make sure to leave a comment down below, or you can hit me up on Telegram. There will be a link to my Telegram group in the description as well. Okay, so let's move on to understanding order flow. Like anything in life, if you don't understand what it is or you can't define it, you don't understand it properly. And if you've not got your notepad out or something to write this down, this is the definition of order flow. In layman's terms, order flow basically is up close candles being respected when we are bearish, and down close candles being respected when we are bullish. And if you trade with this concept in your mind, it will make your trading very easy because you are always in line with the higher time frame order flow. And throughout this video, I am going to put an emphasis on the higher time frame order flow, such as the monthly, weekly and daily chart. This is where banks and large institutions are able to position themselves. They can't position themselves on anything lower than that, because simply their orders are too big, and for the market makers or the market facilitators to facilitate their orders, they have to put them in on a higher time frame. So let's look at this fractal right here. You can see on AED CHF we have been trading lower. Okay, so this is also known as the downtrend. However, we are going to go a bit more into detail. So if we look from this range high to this range low, we are in a premium. And this is how you can map out premium and discount, from the extreme low of a range to the extreme high. So the extreme high was this candle's high right here, and the extreme low was this low made right here. So from this we will use the low to the high and we will find our premium and discount. And obviously anything above 50%, that is a premium, anything below is a discount. And then when we look more deeper into this fractal, you can see that we made a fair value gap. So we're going to go into imbalances later on in the video, but for the sake of this topic, I'm just going to label this a fair value gap. So we have a fair value gap right here, and we have another one overlapping. So this now becomes an inversion level, and this is where we reaccumulate inside of. And then we look at this up close candle right here. So what makes a order block high probability is when we have a fair value gap with it. And if I draw this out in time, you can see that no bodies close above the order block's low. So this was the first telling that institutions were in the market, because as we traded into this up close candle, you can see that we traded into it once, twice, 3 times, 4 times, and we traded away. No bodies were closing even inside of the inversion level or inside of the order block. So this was giving confidence that the market was bearish. And then we have a rejection block right here. So you can see, and price trades into the rejection block, 50% of this wick, and you can see how the bodies are closing beautifully. So this all adds confluence to showing order flow. This shows that we are bearish. And I do have a video on my YouTube channel about order blocks and how we can utilize rejection blocks, and a free PDF on my Twitter page. So as you can see, we traded into the order block, price is traded away, no bodies closed inside of the inversion level. And then we have a rejection block, we used 50% of the wick, and you can see price trades away. Okay, so now we've identified we're in a bearish market, and we've identified that. Now we need to look for an area of liquidity to target. Below this low, we have sell side liquidity resting. I'm just going to get rid of this arrow. So this is the liquidity pool that we will be targeting. And we can use 50% of this wick. You can see around 50% right here. This is where price trades into and we trade away. But we're just going to focus on this area right now. So as we trade away from the rejection block, this area becomes an important area. This up close candle that was made and we had an inversion, this is what we will draw out, and this will become our order block. So as this is our order block and we have a fair value gap right here, no candle should close in 50% of this candle's body. So if we draw out 50% from the body, you can see no candle traded into 50%. We had a wick inside and we traded away. So now this is a valid order block and the order flow is in fact bearish. And once we've seen that this is an order block and these two up close candles right here, they will be our propulsion block. The best propulsion blocks form when we have an order block formed with a rejection block. So that was something for your notepads, but in my study I found the best order blocks form with a rejection block and the best propulsion blocks form when we have a rejection block which forms the order block. So now we traded away from the order block. This is our liquidity pool. We have sell side liquidity below this low, which we trade into. We have an aggressive sell-off, and now we have our propulsion candle. We are utilizing these two candles put together. So if you imagine that this candle was at the low of this, and we will draw out 50% of here, you can see price fails to even go into 50%. However, we trade into the wick of this candle. And on the lower time frames, such as the weekly and the daily, this is an up closed order block, which is getting utilized as a propulsion candle. And you can see we have a sharp sell-off. So those of you that are smart and watched my first video where I spoke about being a scalper in the market, this is the perfect approach to being a scalper. It's looking at order flow and the higher time frames, and you can make a career just from trading like this. How many pips was that? So from if you sold from here, or even if you sold from here, so let's say you were late on selling here, but you sold here, that's around 650 pips. From one position, and you could have pyramided just following the order flow. So now we've had the propulsion candle and price is traded away. As the name says, propulsion, price will trade away aggressively, and that's what we do. We start trading away and we come into this area. And now as price is traded away aggressively, we can look at this up close candle, and this could be another area that we can sell from. You can see price fails to go into there and we just keep trading lower until we go into a consolidation. So now the market is in a consolidation. How can we identify a consolidation? From this candle's high to this candle's low, you can see that we aren't taking liquidity above this high and we're not taking liquidity below this low. So price is inside of a consolidation. However, let's look at the order flow that was made inside of this price leg here. Just going off the logic that I spoke about here, we are going to look at this in a fractal on the lower time frame, such as the daily. Okay, so looking at the daily chart, this is the orange shaded area that I was looking at. Above this high, we have buy side liquidity, and this was the target. And if we are bullish, as I said before, down close candles should support price all the way to the highs. And you can see we have liquidity above these highs, this high, this high. So this is all the buy side liquidity that we will target. And then we will look at this price leg here that happened inside of the consolidation. However, we will look at the down close candles to support price. So this is the first down close candle that supported price going higher. Then we have these three down close candles. They supported price to go higher, and we had a fair value gap, and you can see we had a sharp expansion away and we traded into the buy side liquidity. So now we traded into the liquidity, we can look at another down close candle which supported price to go higher, and now we're inside of a range. As this fair value gap failed, we are not looking for buying opportunities because bullish PD arrays are being disrespected, and we looked at the higher time frame order flow which was bearish on the monthly chart. So you can see that price trades away, and this was an extreme premium. From this low to this high, you can see price trades all the way into a premium and the buy side liquidity. So you're essentially buying the top, and that's something you should never do. You should never buy above old highs and sell below old lows. So we can go into the lower time frames as the 6 hour as well, and everything is fractal. You can see price comes down into this down close candle and we trade away. And you can see right here that we made a down close candle here, price trades into it. We made this down close candle here, price trades into it. We made this down close candle, price trades into it. And we made this down close candle, price trades into it higher. and you can see how fractal following order flow is. And whatever you see on the higher time frames is always applicable on the lower time frames as well. And we can go lower onto the 4 hour. So as I showed you guys before, down close candles support price. You can see this candle starts printing, we trade lower. Come into this down close candle, we trade higher. We have this candle that trades lower, we trade into this down close candle right here. And then we have these down close candles right here. Price can trade into it and we will trade higher. So over here we traded into a discount, we traded into this fair value gap, and we traded higher. And then again right here, we trade into these down close candles that were made here. Price trades away. And the same thing right here. And this is following order flow on the higher time frame. So once you understand this, you will start to understand the market. And especially if you're a swing trader. And this is something that is key to unlocking the market, in my opinion. Once you understand this, it makes your trading much more easy. If you're working a job or you can't look at the markets that much, you can just position yourselves in a swing trade, and then you can let the trade play out and wait for it to go to your take profit or stop loss. Okay, so that was one of the ways to look at technical analysis for order flow. Obviously, there's many other ways to look at order flow, such as knowing the economics of a currency. That can always tip the upper hand for what is going to happen. So if you followed me from January to February, I traded Euro JPY and GBP JPY. This is because the yen futures is very weak. The yen as a currency is very weak. So this caused Euro JPY and GBP JPY to trade up higher with little to no resistance. However, if you look at technical analysis alone, that can help you as well to understand where the market is going to go. And the way I just described it to you, that's probably one of the easiest ways to look at it. In my introduction video, I spoke about why 90% of traders lose. And one of the main things is none of them want to put in the work. So I've given you guys everything on the plate right now. And from the start of this course, it's only 5 videos, but the information in here is priceless. And there will be people that start the course and they'll be like, no, this is too much work. Or they'll start my bootcamp or whatever, and they'll be like, this is too much work for them, and they'll quit. If you're watching this and you've made it this far into the video, I do believe if you do finish this course and if you do put in the work, such as journaling and everything else, I believe that you do have a career in this market. I've said it multiple times, 90% fail because they are half-hearted into this. If you give it your all, even when you want to quit, the markets will reward you. And everything will click, and when it does, you will thank yourself for not giving up. So 90% fail, you listening to this video right now, I want you to be inside of the 10%. Okay, so that was a bit about order flow. Obviously, I'm not going to give away everything because I worked hard for this, and essentially I don't want to give some stuff away. Even if people want to pay me for it, I'm never going to give away what I found in the market, because anyone that has found something solid inside of the market, they'll never sell it. So you see people selling EA robots or whatever. Any EA robot that works in trading, no one is selling it for $50, and that goes the same for knowledge. Whatever the price is, I'm never going to sell something that I worked hard for. But saying that, I do believe this course is worth a lot of money and I'm giving it you for free. Okay, so let's cover liquidity now. So the easiest way that I'm going to describe liquidity is external range liquidity to internal range liquidity. So this is something that the MMXM trader has spoke about as well. And it was inside of his course that he taught everyone. However, I'm going to give my twist toward external range liquidity and internal range liquidity. So it's just a bit more that you guys can note down and utilize in your trading. So when we are looking at external range liquidity and internal range liquidity, we want to look at extreme swing lows and extreme swing highs. So say if price is trading like this, we make a high and we trade lower, and then we make it low. All we need to do from here is wait for price to take out this high or this low. So this is our extreme high, this is our extreme low, and this is the external range liquidity, this is the external range liquidity. So we have buy side liquidity resting above here, we have sell side liquidity resting above here, and anything inside of here, this is what we don't want to touch. Once price trades lower, so we take out this swing low. So you want to look at swing lows and swing highs. If you've not noted that down already, you should do so. So we have a swing low below here. We trade into it, we take out the sell side liquidity. So once we've taken out the external range liquidity, what is the perfect area to target? That is the internal range liquidity. So internal range liquidity comes in forms of fair value gaps, and I'm going to teach you guys another way of looking at external range liquidity. External range liquidity comes in a form of ranges as well. So we can look at this swings range from this high to this swing low, and 50%, this is fair value. This is external range liquidity as well. So we can trade into there. This is where price can rebalance the whole fractal. We can start trading away. And I want you to note this down as well. When there is no area for fair value for the market to go into, it will always seek equilibrium. That's where we see consolidations, and that's where we see time distortion. Okay, so now we're taking the liquidity out and price is trading higher. We can look to enter when we make a fair value gap right here. This is where we can look to long, and we can target the internal range liquidity, which is this range right here. We can either target that, or we can either target this fair value gap. So this is all down to personal preference and what you like as a trader. And then we can look at this swing high that was made here and this low. This is another area of external range liquidity, 50% right here. This is where we can look to take profit as well. So you can look to partial right here. So this is one partial, and your full take profit is inside the full range equilibrium. We are going to go over some examples about this. However, the easiest way to look at liquidity is in form of external and internal range liquidity. And we can look at internal range liquidity to external range liquidity. However, it's more high probability to look at the market from a external range liquidity to internal, but this is where order pairing takes place and price trades back into internal range liquidity to offload the positions. So that's why oftentimes you'll see you enter a trade and it's going nicely, and then we just start trading away back into your stop loss or break even area. This is because we've already accumulated the orders and we've offloaded them into an internal range area, and then price trades away. And this is where understanding order flow comes in as well. So you see how everything is coming together the way I've structured it. Okay, so let's go over some examples on this topic. So let's look at this example on Euro USD. You can see we made this swing low right here. This is our extreme swing low, and this is our extreme swing high. So this is the range that we are dealing with. And you can see 50% overlaps with this internal fair value gap. And if we look below this low, this is where we took sell side liquidity. This was the external range area that we traded into, and price traded away. So as we've already taken out external range liquidity, what is the next area that we can look to target? That's the internal range liquidity inside of this gap, and that is 50% of this whole dealing range. So for external range liquidity, where most people are failing is they don't know how to map it out, and the dealing range is determined from swing highs and swing lows. So we have a swing low right here, and we have a swing high right here. So this is where the dealing range is, and we have external range liquidity resting. And this fair value gap made right here, this is where we will be entering. Our stop loss will go below this swing low, and we will target the buy side liquidity, which is the external range liquidity. And we can take partials inside of 50% of this dealing range, and we have this internal range liquidity pool. That is another area that we can take partials. So this is a perfect area to take a partial. That is 50% of this range. So this is where we will take the first partial. So as you can see, we've been tagged into the trade. Price trades lower, and then we trade higher. So this is where we will take a partial, and we will wait for price to take out the external range liquidity. So once we take out the external range liquidity, which we have done right here, we do nothing. So then we wait for another dealing range to form, where we have clear external range liquidity levels, and we wait for one side of the market to be raided, and then we look to target the opposite end, or we can target the internal range liquidity, which is 50% of the dealing range, or we can target internal fair value gaps. Okay, so now we've gone over one of the most important things in the market, which is liquidity, and we've gone over order flow. And the next topic is going to be imbalances, that we are going to cover fair value gaps and the variations. When we are looking at imbalances, we have two kinds. We have a bearish fair value gap, which is formed like this, where price trades lower, and we make an area right here which is known as the fair value gap. So no selling took place inside of here, and we made an imbalance inside of the market, and this is characterized as a SIBI. So to understand imbalances, you need to understand the definition, and like everything on my channel or my tweets or whatever I preach, I speak about understanding something. So if you can't define something, then you don't truly understand it. So this is a SIBI, this is a sell side imbalance, buy side inefficiency. where you can see this is where only selling was offered. So price was only offered to the downside. To rebalance this, we need to offer buy side inside of here. So that's where the buy side inefficiency comes in. So these markets are efficient, believe it or not. They do offer equal buying and selling. And a SIBI is one of the best PD arrays that ICT has given / spoke about. So this is characterized as a bearish fair value gap. So let's go over a BISI. Okay, so now this is a BISI. I will write this out. And this is a bullish fair value gap. So we have a buy side imbalance and we have a sell side inefficiency. So buy side was offered to the upside and no sell side was offered. So sell side is being offered when we return back into fair value, which is this BISI, and that is our bullish fair value gap. So once price trades in, we block out the sell side imbalance and then we can look for price to trade higher into the buy side liquidity. So this is how you can be characterizing your fair value gaps. I know this is very basic, however, there's not many educators out there that have given a full explanation on fair value gaps in general, what they are by definition, what SIBI and BISI actually means, where the imbalances is. So the buy side imbalance, sell side inefficiency, this is where price comes in, offering sell side lower. This is where we can look for buying opportunities. So that's how you can differentiate fair value gaps. So there's a lot more inefficiencies inside of the market. We have volume imbalances and more. I'm not going to cover that in this video. However, there is a video on my channel going over volume imbalances and various PD arrays that you can utilize. However, volume imbalances are used the same as BISIs and SIBIs. However, they're just characterized as a volume imbalance. And I believe, in my opinion, volume imbalances are one of the strongest algorithmic PD arrays. Okay, so there's a lot more that I can get into about imbalances in general. However, the best teaching is done when you do it yourself on the chart. So I've given you guys the overview of order flow, liquidity, and imbalances. So I've got a homework for anyone that's made it this far into the video. Draw out any fair value gaps made in the past 60 days and see how price reacts to those levels. That is real support and resistance. And that's really where the market is drawing to. This market only does two things. It's always rebalancing an imbalance or creating an imbalance, or we are taking liquidity. So anything other than that is a bonus that you have learned in the market, and you can look to apply it to add extra confluences to your trades. So this was the second video. It was understanding order flow, liquidity, and imbalances. So I heavily preach always that if you guys don't know the definition of something, that you don't understand it. And I've given you the definitions of order flow, liquidity, and imbalances. And I hope you guys found this video insightful and it did help you in understanding what order flow actually is and how we can utilize liquidity and how fair value gaps are characterized. And the third video, I think it will be everyone's favorite video. I'm going to talk about high probability PD arrays and high probability markets. I've had a lot of requests regarding that, so I thought I will involve it inside of my free course for you guys to learn about. So if you made it this far into the video, listening to me talk on and just throw a lot of information out there, I want to say I appreciate you for listening this far into the video. And if you have any questions, make sure to leave them down below. And the last thing is, I want to thank you for watching this far into the video. The third video will be out pretty soon, and I hope you find it insightful as well. As always, thanks for watching.